Thought on real estate and crude, Aaron, since you brought it up, what is your own take on the real estate market globally at this point of time, and crude specifically as well?
Well, with crude, we continue to have short positions. We, probably expect that it would form a bottom at $41 a barrel. If it breaks through that level, we'll continue to be short, but that would be a very, very bearish indicator to break through that support level. However, if you have a long-term view, at least with a real asset like oil, in the long run, the value is going to be there. You can't really say that about any individual stock. 3 years out, 5 years out, 10 years out, oil will certainly be trading at higher levels than where it is today. You cannot say that with certainty about any individual paper asset. So that's why we're focused on real assets like commodities, real estate, rather than paper assets like stocks or corporate bonds or fixed deposits. Also, the outlook on real estate, well, frankly, if you have the liquidity and you can afford to lock up your money, real estate may be cheap, especially in a place like India where I think the population density is 3 times higher than that of China and 10 times higher than that of the United States. So if you could afford real estate, that's certainly great. But we would also advocate having real land, not leveraged property, not taking a loan to buy real estate, but actually owning the property outright.
Which equity markets right now, Aaron, are looking good for a fresh investment? Since you said you don't have any positions in India, which markets globally are looking good? And that is one part. And the other is, what is your call on the US dollar, since you have an exposure to that as well?
Sure. First of all, most of the global equity markets, we still have small short positions. So we don't have a positive. There's a good chance that the market's fallen so far so fast that it could bounce significantly here. Short-term traders might take advantage of that. But for the average investor out there, I just don't see any reason to add to equities at this point or to invest in equities. So that's our view, is basically you can buy any kind of real assets like commodities, a diversified managed futures fund, you can buy gold, you could buy real estate. And these things we know will have a value 5-10 years from now. We just can't say that about equities. So more or less a bearish view on equities, I would say.
Right. Aaron, if you look at the BRIC economies, essentially Brazil, Russia, India, and China, how are you going to strategize between them? Because we've seen an interesting churn, because 2 of them, of course, commodity plays, 2 are services and consumption plays. On exports, you can add to that. So how are you going to really churn between the BRIC economies over the next 6 months?
Well, Brazil is really exciting because you identified that it's a commodity-based country, but it's diversified. They have different soft commodities, they have sugar, they have palm oil, they have all kinds of different commodities. So that's a very good outlook for Brazil. For India, we like India because it has a strong domestic economy. Internally, they're not dependent on necessarily selling to the Western countries like China would be. India has, a very high savings rate of 22% nationwide, which is quite impressive. And the fact is that the average Indian probably doesn't own shares of stock, so hasn't been personally affected too much by the downturn in markets this year. However, the average Indian does own some gold. And that's very, very key, and that's going to become extremely important in the next few years. You asked me earlier about our views on the US dollar. I think Western currencies in general are quite scary. If you look at the USD, if you look at the pound sterling or the euro, just because the actions by these central banks to pump liquidity into the markets with these bailout packages, now bailing out the auto industry. So first bailing out the banks, then bailing out the insurance companies because of the credit default swaps, now bailing out the auto industry. And it's great that, the U.S. government wants to save the private sector, but the question then becomes, who's going to save the government? And basically, the answer to that is the taxpayer. but the taxpayer himself is heavily debted and has several credit cards and a mortgage and all these sorts of issues. So this all adds up to a very bearish sort of view on markets, on equity markets in the West. But it also gives us a bearish view on paper currencies like the U.S. dollar. Because the best way for the U.S. and for some of the Western economies to sort of fight their way out of this indebtedness, the temptation, of course, is going to be just to increase money supply and just print money. And this can have a deflationary effect. So don't be deceived by the fact that commodities have come down in price and people are talking about deflation. Look at the other side of the coin and realize that money supply in all the major economies in the West is growing rapidly. And this is why we recommend real assets.
Right. Aaron, thanks so much for joining us. So gold is the way to be for the next couple of months if you actually track the Superfund asset management company. But we'll head into a short break. We'll come back and put the